Welcome to the TAC Index AI podcast, where we blend tech AP data, reports, and charts with the latest news and all things logistics with a focus on AirCargo. Today, we're doing a deep dive into the air freight market. We've got the latest TAC Index data, some reports, recent news.
Right, and we're trying to connect those numbers specifically from early June 2025 to the bigger picture.
Especially those U.S.-China trade talks that keep shifting. It feels like a bit of a puzzle, doesn't it? How's the market actually holding up with all this policy turbulence?
Okay, yeah, let's unpack that, because what's really fascinating, looking at the TAC Index data for the week ending June 9th, the global air freight market, despite everything, showed surprising resilience.
Right, I saw that. The main index, the global Baltic air freight index, BAI 0000, it just edged slightly lower, only minus 0.6% week on week.
Exactly.
I mean, it's down year on year, sure, about 4.8%, but holding relatively firm like that, given the policy stress, that's notable.
And you have to factor in lower jet fuel prices, too. They're down over, 18% year on year?
Yeah, that definitely helps the carrier's bottom line.
But if we connect this back to, what happened just before,
yeah.
May was really disruptive, remember?
Oh, yeah.
The BI 100 dropped over 6% just month on month in May. That was right after the U.S. tariff hikes kicked in, and they ended that de minimis exemption for small parcels from China.
Right, the one that lets small shipments bypass tariffs. That caused chaos.
Significant turmoil, yeah.
So what changed then, going into early June? The sources we looked at mentioned that tariff rollback in mid-May.
That seems to be key. Taking duties back down from that peak, like 145%, wasn't it?
Back to around 30% for most things, plus some tweaks for e-commerce specifically.
It looks like that provided some immediate, maybe temporary relief and stability.
And that immediate reaction, it just highlights how sensitive air cargo is now to these policy changes, doesn't it?
Absolutely. And it brings up another crucial dynamic we're seeing.
Mm-hmm.
The market is increasingly spot-driven.
Ah, right. Because a lot of those long-term block space agreements, the fixed contracts,
many got canceled earlier this year. So this shift to spot means prices react much, much faster, and potentially more dramatically, to short-term stuff like these policy tweaks.
So how are the carriers playing this strategically? I saw they pulled a lot of capacity back in May.
They did. Grounded nearly 50 freighters on the trans-Pacific routes alone. Reports suggested it was like a 40% withdrawal.
Wow.
Yeah. But the key thing now is they seem pretty cautious about bringing all that capacity straight back.
So they're testing the waters.
Exactly. Testing new lanes, diversifying away from just the main trunk routes, looking more at, Latin America, the Middle East, intra-Asia routes.
Okay. And if we look at the specific lanes in the TICI index data, does that diversification show up?
It does. You see that mixed picture you'd expect. Some big China outbound lanes like Hong Kong and Shanghai were maybe slightly lower or flat last week.
But other places?
But yeah, places like Bangkok and Seoul actually show pretty significant gains year on year, especially go to Europe.
Interesting. And out of Europe?
Well, transatlantic rates heading to the U.S. are still well up compared to last year overall, even if the weekly trends bounce around a bit depending on the city.
And Miami to South America, that's been a strong spot.
It still stands out year on year, definitely. Although maybe some early signs of potential overcapacity creeping in, even there now.
And all this market maneuvering is happening while the diplomats are still talking, right? Reuters reported some kind of framework agreement?
Yeah, officials apparently agreed on a framework to try and get the U.S.-China trade truce back on track. Part of it involved China lifting restrictions on rare earth exports.
And the proposed tariffs?
The report mentioned U.S. tariffs around 55% on Chinese goods and China at 10% on U.S. goods. But that's just the framework.
And how did the market react to that news?
That's what's really interesting. The analysts quoted basically called the reaction muted, kind of indifferent, or just like an agreement to keep talking.
So no big celebration then?
Not really. Everyone's waiting for the details. The devil's in the details, as they say. Some felt the market had already sort of baked in a better outcome anyway.
Leading to a bit of a sell the news situation.
Possibly, yeah, at least initially. The general feeling seems to be, okay, things aren't actively getting worse right now, but we're definitely not looking at a comprehensive solution just yet.
So, wrapping this up, what does this all really mean for you, our listeners?
Well, the air cargo market, looking through the lens of the TAC Index data, is clearly navigating some really complex territory. It's heavily influenced by these fast, unpredictable trade policy shifts.
And the rates, yeah, they show a market that looks relatively firm on the surface, despite the ups and downs.
But underneath those dynamics, we talked about the shift to spot rates, the carriers being super cautious with capacity, the policy flip-flops. It's creating a kind of unstable equilibrium.
So this latest trade framework offers a bit of breathing room, maybe temporary relief, perhaps. But that muted market reaction tells you the real test is going to be in the actual implementation, the fine print.
Which leads us to a bigger question, really. How quickly can air, cargo, and global supply chains generally actually adapt to these rapid, kind of unpredictable changes in trade rules?
And what does that resilience, or maybe lack of it, tell us about how vulnerable the wider macro market might be to these kinds of policy shocks going forward?
Definitely something for you to think about as these trends continue to unfold.